If you own your home outright and you are looking to sell your house, you have an option to find a buyer that will take a mortgage from you, the seller. So you, the seller, would act as the bank owning the mortgage on your own property. So I know that's a little confusing, but you, instead of the bank lending a regular buyer, say 80% and they put 20% down, you, the seller, can own that mortgage against your very own property that you are going to be selling. And here are 4 reasons why this is beneficial to you. So the first point is you are going to be investing in an asset that you know, which is your primary residence or your house that you're currently living in, and you're going to be getting a higher rate of return on that investment than any financial planner would give you. So typically you're going to get 3, maybe 4% return on your money. So you sell your house, say you get $400,000, and you go take that money to a financial planner, you're going to get 3 or 4%. Investors will give you 8 to 10% on that same money. So you're going to be getting a much higher return owning real estate and owning something that you've lived in and you know about. So the second one is the tax implication. If this house is not your primary residence, then you are subject to 50% capital gains tax on the amount. So if you had, say, $400,000 house paid off, you are going to pay tax on $200,000. So that $200,000 would put you in the highest tax rate, which is above 50% on that $200,000. So by offering seller financing, what you can do is not have to pay the tax in a big lump sum. That payment will be distributed to you over payments throughout the years so that you will not have to pay taxes on it. It works out to a huge tax savings for you, the seller, by keeping your money away from that government and having it in that big lump sum. 3 is security. So you can take back that asset if things go south. So just like the bank, if a bank owns the mortgage, that they're putting a lien or registering title against that property, you would do the exact same thing. So if, for instance, you give that investor or buyer the mortgage and they cannot make their mortgage payments, you, the seller, can then take back that asset. So even after 1, 2, 5, 10 years, if they default on their mortgage payments and can't pay, you get that asset back in your possession. The 4th and final point is that the buyer will pay fair market value, possibly even higher, for this vendor take-back mortgage or this seller finance mortgage. So you will not have people lowballing you. You're helping them solve a problem. Some investors who have a lot of money, have a lot of access, have tough times getting mortgages. So if you are offering a solution to them, say for 5 or 10% down, they're going to pay a premium price on your property, which means that you will have it sold for something that you're happy with.